For Morningstar, I'm Christian Charest. Interest rates in much of the developed world hit their historical bottoms during the 2008-2009 financial crisis and haven't moved much since. This has had some serious consequences for investors who are approaching or already in retirement who rely on bonds for a large segment of their portfolios, and they may be tempted to tweak their asset allocation in order to boost their returns. To give some insights on this, I'm joined today by Fran Kinniry. He is a principal with Vanguard's investment strategy group. Mr. Kinniry, thank you very much for being here today.
Thank you, Christian.
To start, can you give us some idea of the impact that low yields have had on investors' portfolios?
Yeah, it's a big deal. As you mentioned, 2008, the global financial crisis pushed interest rates at their historical lows, and the shorter duration, high quality bonds, so the safest securities, very, very low yields. So an investor who had been, throughout the last 20 years up until that point, could easily see 3 to 5% yield on a conservative bond. All of a sudden that is going to 0 to 1%. And so the investor is left with some serious decisions, and that has led them to take on more risk in their bond portfolio at probably the worst times to do that.
And speaking of that, what are some of the behaviors that you've observed people take in reaction to those low yields?
Yeah, so the real highest quality, the sovereign bonds, the government bonds, are the real low yielders. And so for investors who can't accept that yield, we've seen them gravitate towards high yield bonds, so more riskier bonds, corporate bonds. We've seen the yield trade, meaning going into dividend paying stocks. So, a stock has nowhere near the risk characteristics of a bond, very volatile with downside risk. So we're seeing a huge movement up the risk profile for these investors.
Now, do you believe that are people becoming less risk averse today, or are they maybe more conscious of their risk capacity, even if they're not familiar with that academic concept, maybe intuitively they're aware of it?
Yeah, here's an irony, right? So what we see is the narrative that comes out from a lot of places that investors have not gravitated back to the equity market. So bond flows over the last decade have been larger than equity flows. But what that narrative misses is that the stock markets globally are up 2.5 times. So at the asset allocation level, so for a family whose asset allocation in 2009 or entering, today they actually have more equity risk, and their bonds have more equity-like risk. So their profile is riskier today than it was heading into the global financial crisis.
And what are some of the potential pitfalls to taking on this kind of extra risk?
Yeah, so if we do, it's been a while since we've had a bear market. So I think, we all have this recency bias. We don't feel the bear market of 2008 because it's been, 8 years ago. If we do have a bear market, which we probably will in our lifetime, right? The bear market has occurred in the past. So if we see an equity decline of 20, 30, 40%, the bonds are not going to be of high quality because investors have gotten out of the sovereign bonds and into higher credit bonds. So it has an equity-like correlation to it. So if we have a bear market in the equities, the total value of clients may drop further than they did in 2008.
Important warnings there. Thank you very much, Mr. Kinniry.
Thank you, Christian.
And for Morningstar, I'm Christian Charest. Thank you for watching.